All right, perfect. So to kind of start us off today, our panel is going to be about the alternatives, and kind of a loose definition of that product is anything outside of that core stock and kind of bond portfolio, or approaches to that portfolio that might be different. And our panel goal here today is to kind of provide a good takeaways for investors, from our panelists' experiences and knowledge here as speakers and part of their associated businesses. We're going to start off with a quick round of introductions so everyone can get an idea of who will be speaking, and then from there we'll get into it. I'll start with myself. I'm Dan Hughes. I'm an introducing broker based out of Fort Lauderdale. I primarily work with commodities trading advisors as a broker for advisors, so to speak. So in that capacity, I work in the futures landscape, just making sure that the CTAs are well taken care of operationally. I've got a good exposure to that asset class as a part of a mix in the investor's overall portfolio, where someone may have a small portion of their capital allocated to the managed futures space. Why don't you, Paul, you go ahead.
I'm Paul Foley. I'm a partner here at Ackerman. I run our investment management team. I represent over 400 investment managers around the country of all shapes and sizes, and pretty much every strategy.
Good morning. I'm Arun Kaul with AK Global. We're an outsourced CIO. We're also based in Fort Lauderdale. We work primarily with advisors and family offices, providing a range of services, both direct management, some on the alt side in terms of long, short, market neutral, and also a lot of manager research and due diligence on the alt space, as well as investment strategy, and some work on the policy side in terms of asset allocation, investment policy as well.
Perfect. And we got Evelyn remotely. Evelyn?
Hi, how are you? Good morning from New York. I work with private equity and venture capital, most focusing around venture capital. I work with two venture capital funds. One is early stage, 2VC. The other one is the K funds, which is a later stage venture capital fund, both in technology. And in that capacity there on the board, I help them with new investments and also the relationship with the LPs that we have and LPs in our network. And I also am on the board of a hedge fund, which is a long equity fund. That's a public markets fund.
Okay, perfect. And we'll kind of start off on a very general basis. What would you say, guys, are some of the best performers in 2023 that we've seen on the alternative side, and kind of what can we expect in 2024 from your perspective? Paul, if you want to.
Best performers might be different than most popular strategies, but definitely the most popular strategy this year, as far as formations go and new startups, has been private credit, really across the board, all different types of strategies and lending to different folks, from effectively payday lending for businesses to providing mezz to different real estate providers, and then also providing much needed capital to operating businesses. We've seen that across the board. I'm not sure that that's necessarily been the best performing, but it's definitely been the most popular.
And that's really benefited from the rise in rates, so to speak, as well.
Well, the rise in rates, but then also, really the pullout of a number of the banks and lending on that side. And so there's just not as much traditional bank lending available. And so this is alternative cash that's available to folks that's much more expensive. With that expense comes additional risk for those borrowers and for the lender.
So you've seen a bunch of family offices and firms kind of jump in that private credit space and take place of the banks who have lent less because of the reg requirements they have on the unrealized losses that they might be holding.
Absolutely, we've seen a ton of that, and and then there's a rush for say you're $1 billion manager and you have a strategy where you're just doing growth by private equity. Now all of a sudden they want to start their own private credit fund to kind of take advantage of the opportunity. I mean, we've seen a lot of that, and we've seen a lot of that mission creep.
Yeah, I've seen just on a basic level when you've got kind of equities at such an elevated valuation and you've got rates come up, you really have got strategies out there, especially on the credit side, that had kind of been ignored for a long time. And now you've got meaningful valuation in terms of not only could something appreciate, but you've actually got payout now, where before the rates weren't there. Arun, what would you say you've seen lately?
So, yeah, I agree with the private credit. We've certainly seen a tremendous interest in that area. I would caution somewhat on that sector. I mean, it's kind of referred to as middle market. Middle market's a little bit of a misnomer. It's not really the middle, it's small cap and micro cap. So if you're looking at it relative to your public portfolio or your S&P portfolio, you know, historically it's been EBITDA between 5 million to maybe 100 million, which is solidly below the S&P small cap, which is around 200 million. Russell 2000, I think half the names now aren't even profitable, but those that are profitable, they're smaller, you know, they're larger in size than that historically middle market. So we've seen tremendous interest in that, but I don't know that, especially on the retail side, you're seeing a lot of it as well in terms of the product coming into the advisory channel. I'm not sure that everyone thinks of it as high yield or, to be equivalent to a junk bond basically, or unrated bond. And then obviously you're getting 9, 10, 11% yields, which is very appealing. However, someone has to pay 11% yield on the other side. So it's hard to have an ROE that covers the 9% yield. Nonetheless, huge interest. I don't think it's slowing down. I think that maybe it's not quite positioned from a risk perspective as well as it should be in the portfolio. So that's certainly been a big area of interest. And I think when you get to the other areas, and again, we can go through these, but I think it's very sector and segment specific and potentially region specific. And I'd come back to maybe talk about the market as well. When you look at the valuations, there's a reason why there's such a massive spread on valuations across all of these different sectors tied to the growth and profitability. And I think that's equally true in all the alternative classes, whether it's venture or real estate or private equity. There's a tremendous spread on valuation. So I think there's there's growth across the board, but I think you have to be very sector or regional specific in terms of how that's being positioned in the portfolio.
And I agree on the private credit with respect to the companies that are actually borrowing the funds. But I think the bigger risk there is the people making the loans may or may not actually have real experience in lending to these types of companies at these kinds of rates. And that's the bigger risk that I see. And, I talk to these folks on the front end, and yeah, that's a real risk and something from a due diligence standpoint you want to really look at.
Yeah, especially with rates at a level where it's actually a meaningful number. They're not doing a 1 or 2%, with Fed funds at 0.
Yeah, it's not free money.
Evelyn, what would you say that you might have seen lately in terms of the best performers in your perspective in 2023 and what you're really looking at for 2024 for in the alternative side?
Yeah, I agree with the panel. I invested money for family offices for 20 years, and then I assessed another one. So now working with the funds, I continue to be in the family office space. And I was amazed with how many mom and pops credit funds showed up in the market this year. It was like crazy. And because they were looking at an alternative that would have families really like real estate because you have the coupon, you get the money every year, and they like the money flowing. And the alternative was some other, fixed rate products that had, not a high return. So this private credit came like, a great alternative. And I would be cautious because I think that number one, as the last speaker said, we don't know who is really experiencing that area. This is an area that has always been played by the banks and other large private equity funds are going to be getting like the large and the good deals. So we have all those little companies that you don't know if they're going, what the shape that they are. So I think that my experience is that when you have something that pops up like that so quickly and everybody jumps in, is going to have like bad returns. Not going to be expected returns, and sometimes a lot of bad news. Probably now in 2024 and 2025. Not immediately 2024, because I don't think that the Fed is going to be cutting rates like the market expects in March. I think it's going to be a little not as fast. So having said that, in terms of investments, I think that venture capital was a slash to the bottom the past 2 years. And I think that now is a good time to get in because most of the venture capital funds are raising and valuations have come down a lot. And I think that you're going to have a very, good 5 years of growth in the venture capital world, and the IPO space is opening up. Markets are. So I would go, again, very cautious. I don't like private credit, only if I'm investing in a very large private equity firm that built like this $1 billion, private credit instrument. But the little ones, I will be cautious, and I'll be looking into venture capital. And I'm not a big fan of digital currencies, but I think that now the FTX and all the crisis is over. I think that this thing is finding a footing again, and it could be a good opportunity for the long run.
Yeah, on that note, with FTX and just the regulatory environment in general, we've definitely seen the SEC, step up to try and make regulation a little bit more efficient. And something that really came out recently was this, the private fund rule, or that the SEC came to implement changes that might affect the alternative strategy a lot more than your typical investment regulations that are out there. And I guess, Paul, you might be able to speak a little bit about this. What is this private fund rule, and how is that kind of affecting things for an investor standpoint, positively or negatively, or what are your comments kind of there?
Sure. Well, the current regulatory environment for the SEC and Gary Gensler tend to be pretty aggressive with respect to regulations, and maybe that's the understatement of this whole show, that is as far as being aggressive, but
yeah,
in terms of just really trying to go after folks, and not just for fraud. I mean, going after folks for ticky-tack type violations, and they've been very aggressive with our clients and the examination staff and the enforcement staff. We're really seeing it. It's interesting that they haven't done anything on crypto, and they're specific to crypto. I think there's plenty of most of the assets are kind of covered under the existing framework, and folks try to claim that it's not clear because they don't like what the law is. But with the private fund rule, it's really interesting, and it doesn't really go into effect for another 10 months for the largest firms, and then about 14 months for the others. It's currently being challenged in the Fifth Circuit by a number of industry groups. I suspect they're going to find some success with respect to their challenge. There's a lot of industry groups that are aligned that this may not actually become an effective rule, even though it's already a final rule. But some of the changes that they really focused on are the side letters and limiting preferential treatment that investors can get, and that's going to be a game changer for the industry. And then a lot in the tax. I'm speaking at a tax and accounting forum in a couple of days, and the tax and accounting changes are really enormous burden for small and large fund managers. We're already having trouble getting our funds audited on a timely basis, and the auditors who just don't have the bandwidth. And I think the SEC estimated that another 5,000 audits would need to be conducted based on this rule. I don't know where those auditors we're going to find them. I mean, we're having trouble finding lawyers, but they're really having trouble finding accountants.
And basically, a lot of that refers to with the funds needing to segregate and classify and disclose, and not necessarily just lump sum certain costs into the fund.
Well, yeah, there's certain things where you have to be very clear about what you are charging to the fund and how you're charging it to the fund. Sounds like Marty. It looks like Marty has a question.
No, I was just gonna make a point, which is there's a big wave of operational people and accountants
Yeah.
hiring.
Yeah, well, we're seeing that across from a service provider standpoint, there just aren't the lawyers, and folks
Right.
expect a level of service that they became accustomed to maybe 10 years ago. It's not there. I don't have the people. We try really hard, and on the accounting side, we have regulatory deadlines we have to meet, or our clients, the fund managers, and the accountants are often just missing them year after year. It's really problematic.
Hi, Arun, do you have much experience on the private funds side, so to speak, with your portfolio construction in terms of a balance as the CIO component that you have?
I was just gonna comment on the regulatory side, just on some of the regulatory issues, maybe from a portfolio context, which is that when we look at the alt space, and when we look at some of the regulations on the energy, and even in terms of production for semiconductors and a lot of the bills that are forcing production to come back to the US or to not be in other locations, it's all highly at the margin inflationary. So it comes back to the alt strategies and some of the portfolio positioning for next year or for the next couple of years. I think there's a definite bias towards the structure being inflationary. So when we look at the different strategies, I think that inflation tail is an important component to how you think about building the portfolio, because the regulations, and this is similar, so we look at some of these regulations, they're just restricting the ability to produce the product, or they're increasing the cost of compliance to
Right.
generate the product. And in this case, with semiconductors and energy, we're restricting the supply of energy, and you can't force demand. So I think the EV mandate, I think there's a piece in today's journal about forcing California trying to get EV sales to a certain level by 2032. So you can't force the demand if the demand's not there. So we're having these significant distortions between supply and demand across vehicles and energy. And it's in semiconductors as well. It's not as easy to see, but it's there. And then it's coming now for agriculture in terms of climate and cows and other ways to restrict or increase the cost of maintaining cattle, which will then drive the cost to be higher. So these are all inflationary at the margin, which I think leads us to a higher inflationary backdrop looking forward to the next few years.
And
Yeah,
it's a little counterintuitive, but more regulation only helps the large entrenched established players, and it helps them create a moat around their businesses. And people are saying, oh, we gotta go after Wall Street because they don't, and then really what they're doing is making it so there isn't as much innovation. There aren't as many people who are able to come in and new players to just shake up that system.
I think that's very true. I think that's a really important point. So that cost structure flows through, and you have what we're seeing in the economy today, which is I think part of the challenge, is that the cost structure is impacting different size entities to a different degree. So some of the very large firms are really not impacted at all, and some of the smaller firms are impacted tremendously. And that's the same more so at the individual level with different income level. You're seeing the same things. You're seeing, I think, more stratification or fragmentation, where on average you might say, well, this looks okay, but if you break it down into the segments, you see a pretty large dispersion across either sector or business or individual wealth in terms of income.
yeah. And one thing I can say for sure, investor due diligence is definitely important for any time you're looking at an alternative investment vehicle, so to speak, that you come across, regardless of the industry that it might be in. In terms of hot topics we've seen lately, obviously with OpenAI and the leadership change that they have had and things like that. On the I know we're going to go into the specific industries with healthcare to follow after this. But does anyone have any commentary on things they might have seen on the alternative investment, on artificial intelligence kind of industry, so to speak? Are there any particular fields that's going to help more so than others in 2024 to kind of be expected? If Arun, do you have any?
I don't. I mean, it's obviously, it's penetrating all different segments, all different areas.
Yeah.
So I think to some degree it's difficult to measure, and to some degree it hasn't been fully monetized either. Other than from a software perspective, if you look at the margins on the underlying firms that are able to, that are effectively software firms, their margins are increasing notably from already being 35 or 40 or 40% to being another 3 or 4 or 5% higher across the Adobe and Intuit and Microsoft. So I think that segment is the initial beneficiary. And then the firms that are obviously able to utilize some of the software, all the asset-light businesses have significant margin drivers. Someone like Tesla is interesting because they have a tremendous amount of data, which will be able to then be utilized at some perspective from the AI space, but their underlying business is not as high on the margin side. They used to be 15, which was big for car companies, but now they're down to 10. But they, I think, have the ability to monetize the data, which will then feed into some, I think, still to be created application with all the data they have in terms of driving and data from that perspective. So I think it's in a lot of different areas. It's monetized first in software, and it's going to flow through a tremendous amount of areas in how it gets monetized.
On a basic
Starlink?
Starlink, is that what?
Yeah.
Marty was
That sounds
asking?
on that.
I haven't done, that's one area I have not done a tremendous amount of work in Starlink.
I can basically say just on a basic level, used to have a hotspot when you ran around town, or even if you took a boat from, Miami to the Bahamas. Now, basically, Starlink, you've really started to see them kind of approach that retail market where now you can replace that for not much more money with the Starlink.
They're gonna be doing $15 billion next year in revenue.
It'll be interesting to see how it plays out. And then on the
And
corporate,
the cloud data is phenomenal with the guy.
yeah, and then on the AI segment in general, I think they just recently permitted businesses to really utilize the models in a private setting and not in a training environment as well. So, previously, everything was training the models, and they really recently just opened it, I think within the past couple of months, to really let a company utilize it without having to worry about their sensitive information being incorporated into an overall sphere of knowledge, which would obviously pose a risk for companies that are out there.
I would just add that a lot of the day, we've done a lot of work on factor modeling and quant investing back in the day, and that evolved to high frequency trading and then scalping basically on the trading side.
Yeah.
What happens is you get faster and faster frequency,
Mhm.
but with the data, you end up getting a lot of noise in the short term. So when you try and disaggregate client signals or market signals or product signals or individual behavior, a lot of times there's a tremendous amount of short-term noise that may not be a good long-term signal. So I think it's still unclear how AI disaggregates the short-term noise from what's a true, meaningful, longer-term signal. And in consumer data and spending patterns, you can find all kinds of short-term noise that may or may not be a legitimate relationship in terms of driving or causing behavior.
Why can't you use AI to create noise?
You can definitely use it to create noise, right? But I'm saying in terms of trying to make it persistent. And then when you look at alpha, or you look at your signals and models, you're trying to get persistency. So if you look at AI and you get a lot of noise, or you create noise, or you have fake data that's creating noise, it's very hard to rely on as a reliable signal. You'll have lots of information, you have lots of data, but whether it's actually accurate or persistent, I think is a completely different question. But no one's going to know because they've got so much data they've never seen before. It looks amazing, and you go, okay, what do I actually do with this, or how does it persist, or will it persist, or what's causing it to persist?
And then Evelyn, what are your thoughts? Do you have anything that you've been looking at lately that might be positively or negatively affected by AI this coming year with it being in the news so much?
Yeah, so, we just had a shareholder meeting that it was all about AI in Utah a couple of weeks ago for one of the funds. And I learned a lot. A couple of things I want to say, what I learned and what I'm seeing in the market. AI has been around, for a while. Like, even Netflix had AI and nobody was naming it. So I remember a couple of years ago when I was with Alpha Square, which is one of the family offices that I work with, they only wanted to look at Web3. Nobody talks about Web3, it's gone. So everything is AI. So AI has been around, and now most of the big companies and other companies are trying to surface like, what is the AI that I have? But what is in the market right now that most of the GPs and LPs are looking at is AI related to medtech and healthcare. Talking about data, that's the and health tech, yeah, because that's where you have a lot of data, and that's where you can use the data both to assist, the patient immediately, like, helping doctors and helping diagnosis and so on. And then you have the data that is used for research. So those are areas that the funds, both LPs and GPs are looking a lot, is AI related to the health sector. You have AI also in fintech, but you have so much noise in fintech and other consumer related internet companies that it can be fake, you can have, and this noise kind of goes away when it goes into health, because that's like more sophisticated, it's like hardcore data. And that's why I think that a lot of the funds are looking, and you have some funds that are coming into the market that only invest in AI, in health tech and med tech. And basically, I think they're answering the demands from the LPs.
Okay, well, someone will have to reach out if you have any ideas on the specific ones to look at. Something that we've kind of seen since 2020 really has been kind of a rise of the retail investor with the different products that came out from regulatory change to allow crowdfunding, which led to products that would invest in art, wine, real estate, overall move to fractionalization. Paul, do you have any commentary that you might be able to give as on the legal side of what's really, you've seen in that landscape?
Yeah, I worked really hard with a number of states to actually pass the state crowdfunding laws and kind of tweak them around. And we were really excited about all the different crowdfunding laws when they kind of came into existence. I think the clients who have utilized crowdfunding have not found it to be the panacea that they hoped it would be. It's difficult, and when you're raising small amounts of money from lots of different people, there's a lot of regulatory risk. The SEC is very interested, the state regulators are very interested, and their plaintiffs' lawyers are very interested as well. And you got somebody who invested $5,000 in your thing, and you might not have any liquidity, and now they're bitching and they're saying they're going to go somewhere and they're gonna say this is a Ponzi scheme or whatever else. And I mean, that's not a hypothetical. And then now we have the SEC I'm dealing with various clients on those kinds of issues. Dealing with retail investors is extremely difficult, and I think you really need to be a larger and more institutional type firm, and you need to be run like a bank. And it's really hard to do that in the current regulatory environment and with really good plaintiffs attorneys out there. So it's something you want to make sure you're doing right, because I think there's a lot of folks out there that think that, oh, just because it's out there or I can get on this platform, somehow it's legal. A lot of those platforms are not doing it correctly. Some of them are, and particularly in the real estate side, there's some that are working pretty well.
So definitely worthwhile to make sure you do your due diligence on the platform provider itself, in addition to the product that they might be looking at.
Correct.
Yeah,
And
I have a comment. Hello. I have a
crowdfunding. 30% of the money raised goes to the marketing to raise the money.
There's a lot. The fees, I don't see it being that high usually on the more established platforms. It's pretty significant, the amount of money that goes and that's being paid. But there's a lot of expense in trying to get out to 1,000 investors at 2,000 a pop. It's really hard.
Evelyn, what were you gonna say?
Yeah, I was going to say something. I was approached by one of those new alternative investments that would do like for retail and crowdfunding, and so they're looking for people on the board, and then they were so crazy about getting retail investors on board, and then this guy said, I have this guy in Europe that reached out. He's going to invest $100 million, and I said, but who is this person? So the other thing that is interesting is that the platforms, I don't know if they're doing themselves the research, where is this money coming from? Who are those investors, right? And it's hard for them to do that because they're all virtual. Somebody from Europe says, I'm a billionaire, and then they send whatever fake, profile. And I don't see those platforms, and I'll ask, the panel if they do. I mean, are they doing the due diligence? Like, who are those investors coming into the platform?
Yeah, you definitely want to make sure they've got a good legal team to help them, because on a basic level, any fund has to have some component to those AML, KYC procedures that have to be in place, because now we're an increasingly global, accessible marketplace out here, that different countries even have different regulations, and some firms might need to be regulated in one way in the US, but then also follow other regulatory requirements as well. So you definitely want to make sure they've got a good legal team with them as well.
Yeah, I mean, with the Russian sanctions, you can really end up in a bad spot and be very sideways with the U.S. government if you're providing certain services or you have certain investors from that area. But most of these platforms, regardless of what the underlying asset is, if you're only buying a fractionalized piece, that's very likely to be a security. It meets the hallmarks of the classic definition, and you'll hear people argue that it's not a security, this one's different, and like, well, no, the rule was written for every different thing, and there's certain hallmarks, and it's not that different. So most of these platforms do need to be registered as a broker-dealer. As a registered broker-dealer, you have AML, KYC requirements, and so they should be covered, but a lot of these platforms aren't properly registered, and so that's something to look for as well.
Yeah, with anything, you definitely want to make sure you do a thorough legal review, whether it's a fund or a platform. And then Arun, do you have any thoughts on other asset classes that in portfolio kind of construction?
Yeah, and I was just gonna comment on, just on the platforms as well, separate from crowdfunding, but the proliferation of the funds to the kind of private client market. A lot of them are now coming in as 40 Act funds, so there is at
Okay.
least some regulation, which is
Right.
good, and I'm seeing in even interval funds as well, which at least offer some liquidity. So there are many funds, and some of the larger firms are coming through that, separate from the crowdfunding, but just the actual traditional alt funds in terms of private equity and private credit. So I think that's a positive, but you are getting some very low minimums. You're definitely getting down to $2,000, $2,500 in terms of the minimums for some of these strategies. But we're definitely seeing more coming through the SEC or through the 40 Act lens.
Sure, and if you have a mutual fund now, whether these guys are prepared for a run on the fund is something completely different, and whether they
Yes.
manage their
Correct,
liquidity right.
Yeah, I agree with that. So they're generally doing about a 10 or 15% liquidity sleeve to what would be a traditionally illiquid type of strategy. And then the interval fund, obviously, they have maybe a small draw, but I agree that eventually, or if you have some period of stress, they're all going to be stressed at the same time in the same place. I do actually think that's a big, when you just come back to portfolio design, or you're asking about portfolio design, I think that's actually a big issue, is that as the alt markets grow, secondaries in particular, you've got a much closer linkage between the private and the public markets. It's very hard to argue that your mark on your private fund is 10 when the secondary market is to trade at 9. So if that's going to effectively arbitrage the prices between public and private markets, but I think you're going to see higher correlations between public and private markets at a faster pace than you might have seen typically. So there's been a lag with real estate. There's always been about a 1-year lag between public and private markets. Those are the same assets. It's a little bit easier to say, well, to take a market in real estate, you can't ignore the market. The public market is taking down hotels or warehouse or offices. Private equity is a little different because obviously you've got multiple different segments. However, if you got a big secondaries market, which is another area that I think is definitely good for next year in terms of opportunities of buying assets at a discount.
Right.
But that's got to flow through the PE person who still owns the other 80% of the asset. So I think you're going to see on a portfolio design side, you're going to see higher correlations. So I think that's going to be a larger issue going forward.
And that's where you definitely want to spend time finding the good managers and having the right partners in identifying the opportunities. Because otherwise you might find a great opportunity, but then there's a weak link to that, or something the manager might not be doing correctly, that then takes what could be a great deal, but then gets sidelined by something they're not doing right procedurally. So the due diligence aspect is
Right.
definitely important.
Definitely, I think Evelyn mentioned small and large managers. I think that's another significant dichotomy. So the large managers are so large, and they will argue they have 100 staff on the strategy in 20 different countries, and that's their edge. But now they have issues of capacity because they're so large that the alpha has to decay to some degree. And then the smaller managers who don't have capacity have tremendous scope for alpha, but have a higher hurdle in terms of compliance and due diligence. So if you go back in the day, the mutual fund manager got to a certain size, the alpha decayed, the active share went down. Hedge fund, the first question I was asked was, what's your capacity? And now I think as you get to private equity, you got to ask, what's your capacity? And people don't. The due diligence doesn't generally do that. They're more concerned about the structure, the offering, but they're not coming in from a capacity perspective.
Can you define capacity? Because I think there's two versions of capacity, right? How much assets can you take? And most people say, well, the market is this, versus how much assets can you take and preserve alpha?
So I agree, it's both, and it depends on the strategy specifically. So I'll take the easiest one is infrastructure. I think infrastructure, those are huge firms with tremendous size where you need a lot of dollars to put money into infrastructure. So you can say we have a 20, 30, 40, $50 billion infrastructure fund. There's plenty of firms that are that size that can use that level of capital. So to me, that's the easiest one. And then real estate is next, where there's lots of build, obviously it's a huge market. So you've got tremendous money you can put in it. When you get to the company level, when you get to private equity, venture capital, and growth capital, and secondaries, then you definitely have issues with capacity because you have to pay. You're just much more sensitive to the multiple, what the overall market multiple is. But I think the capacity, it should still be asked, and the manager should have a good answer, right? They should know there's a good answer to it. A lot of times when you ask the hedge fund manager what the capacity was, if you didn't get a good answer, that was a good reason to not put money with that hedge fund.
how do you determine alpha in an infrastructure project?
That's another great question, right? So I think that's where we're going. So that's all of these funds now. If you look at the overlap between these really large firms on the private equity side, look at Apollo and KKR, those large firms, they've got huge real estate funds, they have huge private equity funds. Now they've got some pretty large infrastructure funds and they have tremendous amount of overlap. And they've got co-investments happening in affiliate investments inside each of their funds. So, just kind of getting to what the overall capacity is and what the alpha is and what they're going to benchmark it to. I think those are all critical points when you get back to portfolio design, when you get back to asset allocation with alts. But there should be an answer. There has to be a benchmark relative to something. If you're doing private credit, you can say, well, let's use the ag and we'll do, bonds +4, bonds +3. That's reasonable. But assuming you're taking some level of risk. If you're doing private equity or venture capital, you come back and you'd use the S&P and do the same thing, S&P plus X, whatever it happens to be. I think that makes sense. Or I think you can break it down into income and growth, because I think there'll be a tremendous demand still for income product. So you come back to private credit or bank lending and say, I want some level of income using the bond, the ag is a benchmark. But I think that's pretty important in terms of how you design the overall portfolio and how you position the alternative strategy.
Yeah, on a basic level, with the volatility that we thought we might have really had, that kind of showed its face for a little bit. Now market just rallied, 9% last month. From my perspective, you definitely see a little bit more interest in tail, wing strategies that kind of help look for sudden rash moves and volatility. I think the VIX is just back down to 13 or so. So it's kind of very dynamic position that we're in with rates above 5% and VIX back below 14 now. So you definitely see more interest from my perspective on people looking to capture, what happens if we get more volatile? Where do we go from here with volatility so low, with rates so unprecedentedly high in the recent memory? So a lot of the traders out there were not around simply for the times that occurred when you had significantly higher rates.
We see a lot of these smaller managers able to take advantage of inefficiencies in the market. I think the larger the opportunity, the more competitors there are in the market, the bigger funds. If you're talking about the large cap stocks, I don't believe markets are efficient, but they're a lot more efficient at that level than they are at levels that some of these emerging managers can really look at. And in certain markets, like in real estate, you're in a tertiary market in some place, there's a lot of value add, and there's a lot that these smaller managers who don't have teams of 100 can actually deploy capital and make investors a lot of money. And I watch that happen every day. So I don't want to get lost in the Apollos of the world. Sure, they're great, but there are ways to diversify yourself. And there are people who are competing who are really able to outpunch their weight in less competitive markets where the other folks, the smartest or best and brightest allegedly can't be, because they have to deploy 50 million on every investment, and there's an opportunity to deploy 2 million here or there.
Yeah,
I think that's a great point. So the due diligence skews the opposite way. The due diligence favors the largest firms with the most assets and the longest track record, and the alpha favors the smaller firms with less assets and more niche opportunities. So if you look at the large platforms now, an iCapital or a Case, they've started with the largest of the largest firms first, and a lot of less sophisticated advisors are offsetting their due diligence on iCapital, and iCapital has exactly what you think they have on the platform in terms of the initial first set of managers. So I think that if you get the due diligence to reverse, there's tremendous opportunity in that.
Okay, and Evelyn, do you have some final points that you'd like to put out?
I wanted to, what we're looking into, and I think one of the things that the panel said that I really agree is that you have a lot of capital involved in the last firm, these big firms, to invest in infrastructure. And you have like 3 funds that end up maybe investing in the same project because you just don't have, the bandwidth. But the opportunity that we're looking, because when you look at the infrastructure, primarily in the US with the new, plan that is in place here, the infrastructure plan, you have transportation, you have energy, you have communication, and in the venture capital side, you have a lot of innovation that space that you can play infrastructure in smaller companies. And this goes into robotics, goes into supply chain, goes into AI for transportation, and including, talk about again, infrastructure, you have other investments related to space that also monitors that whole infrastructure development and environment. So I think that you're going to have a bigger alpha, and really in the long term, if you invest in infrastructure in the smaller players, like meaning if you look at funds that are investing in that segment in the innovation, both for communication, transportation, and I would include also manufacturing, because we have the manufacturing for instance, I have looked at a lot of projects in the energy storage space, because you have the alternative energy, and then you have to, and most of those companies are smaller companies, and then they are going to be either acquired by the larger companies, they can IPO, and I think you're going to see better alpha there than going to the, I mean, let the huge LPs like Calpas and Calstras invest in Apollo and BlackRock, and go into the more innovative GPs that are investing in that space.
Perfect. And then Paul, would you have some final points?
I don't know that I have great final points. I do agree with that venture capital, it's been really hard for our clients to raise money over the last year or two. And it's been interesting watching them try to prop up a lot of these portfolio companies and figure out ways to keep that moving forward. And I think the companies that survive, there's more likely a reason for that. And I think, the funds that are raising now are very likely to do very well.
Because the cost of funding costs more money, so it's not as easy to just go out and raise capital as it was.
And they can be a lot more selective with where they're allocating their funds, because there's just gonna be less money finally, I think on the venture side at some point in the next year or two. The level of dry capital though, on the private equity side, I think it was estimated at some huge number. I don't want to get it wrong.
Dry capital?
Dry capital on the private equity side and on the venture capital side, and it's really high. I mean, we went through it here last year when we were thinking that there's going to be a recession, and we're like, we could count up all our clients. We're like, okay, that's a lot of billions of dollars that has to be deployed. We're going to be okay. We're going to keep everybody here, and we're going to keep doing deals because our clients are going to need to do deals. And so that's going to continue to happen, but that's starting to dry up on the venture capital side. So I really think that funds that are being raised today are going to do well. I think it's kind of dovetailing a little bit on what Tim had said yesterday, Draper, where he's just kind of talking about it, every 3 or 4 years after things aren't great. But I don't know where anything's headed, but that's probably the one area I really like. And I also like emerging managers. All right, Marty.
I have a couple of questions. I believe I want to.
Okay, cool.
So having been through 2008, I'm under the impression that, so if you went into the secondaries market, the spreads just in 2009 blasted out to like 40–50%, bid ask spreads on secondaries. And a lot of people just, they said, okay, great, I'm gonna go and get a loan of my art or something like that, and I'm gonna extend and not sell this at this ridiculous price, right? But the Fed cut rates. That's not happening this time. I know Rich Jones gonna talk later.
It's election year. It's election year. I don't know.
Well, even if they cut rates from 7%, it's not going back down to 0. Right? So I think there's something catastrophic out there. Because people are gonna have to sell.
Well, you got something that'll happen when you got 2 different wars out there. You got 5% rates, you got VIX below 15. You got a lot of valuations marked to private numbers that'll at some point,
market, right?
at some point will come up.
Yeah. I don't know.
But go ahead.
Can you speak to the state of cram downs, down rounds, and whether we should be pivoting from venture capital to vulture capital? Can you talk a little bit about
So
that?
the question was venture capital to vulture capital. I think, Arun, you mentioned that that distress kind of, and that's what you referred to on the secondary side of secondarily traded interests.
So a couple things. I think first, just at the big picture level, the last 15 years are the anomaly in terms of where rates were, right? So that environment is not the norm. So where we are today with rates at 4 or 5 is the norm. So to be fair, the Fed has tremendous room to ease policy if, when, or as required. You don't have to go to 0, but just go back to 3 or 2.5, whatever the number is, that's a lot of space. Right, that's a tremendous amount of cost reduction. So that allows mortgages, which right now come from 8 down to 7.8 or whatever the number is, that gives them a lot of room. So there is room from a cost perspective. Their side is that the interest is so high now that the interest cost at the federal debt level will eat into all those expenditures. So that's a stress point that's definitely coming. But to the point of the portfolio positioning, I think what's changed, if you go back to 08 and 09 to your question, Marty, is there's more capital on all sides of the capital markets, whether it's venture, whether it's cram down, whether it's secondaries, and I think, or distressed, right? So everything is now opportunistic, which means you could be distressed, or you could be a secondary, or you could be a co-investment, you can be whatever you want. So I think there's more capital available. I think you have a bigger chance to go sideways in terms of the market just going sideways, but you have to be a lot faster in terms of, if you want to be a vulture, you gotta be pretty quick, because the opportunities won't last. So whether it's dry powder on the private equity side, whether it's a large publicly traded firm stepping in and taking an entity internally, a huge multiple, they don't care. If you're at Google, you have $140 billion of cash on your balance sheet. That can support a lot of firms at a 10 billion multiple on something that has no revenues. So you have a tremendous amount of cash in the system that I think will make the vulture opportunity, you gotta be really quick.
Yeah,
And there's lots of them.
cash on the sidelines now does a lot more than it did,
Well,
previously with no.
But there's a lot of cash. So there's a lot of cash to come out of the sidelines. So as soon as rates, or if rates start to come back, there's a tremendous amount of money sitting in money market funds on top of dry powder sitting inside private equity, on top of Google's $140 billion and Apple's, whatever it is, only $80 billion, or, there's a tremendous amount of cash in those large 7 firms. They have huge balance sheets and they're little ecosystems unto themselves.
But pre-pandemic, right around the start of the pandemic, we were forming all kinds of distressed private equity, distressed venture capital funds. My experience has been that they really didn't find anywhere to deploy that capital. And the main reason kind of goes back to what we were just talking about with Marty, is there's so much dry capital at the non-distressed firms, and they're all incentivized to keep the music playing at the current valuations, whether they're buying from themselves or from someone else. And that's something to remember. And that gets you through a cycle.
I think that's also inflationary in terms of the overall availability of cash in the system. But I would come back to valuations, which we didn't really kind of touch on entirely. The market looks expensive, and I think it's expensive relative to cash and bonds. But if you look at the large firms that are driving the valuations, they're not that expensive relative to what they're doing. So if you look at NVIDIA and you look at Microsoft, you look at these firms, they have huge margins. They're running margins of 30, 35, 40, 45%, and they're growing. So if you run a screen on what the top growth stocks are, you get those firms. So Tesla doesn't have as high margins, but they've got huge top line growth. So on valuations, right, it's people think, or the comment is the stock looks expensive, but the multiples on the total asset, whatever the total addressable market is, and how much share they're potentially going to get out of that market, which may not even exist in certain cases. So the multiples, there's a huge disparity on multiples, both in the public market and when you go to the private market. And I think that's going to persist. So Eli Lilly is a good example. The stock's at 50 times earnings on a new, weight loss drug that will potentially be the entire market. So how big is that market? One company captures the majority of the drug, and that gets priced in, and then you have to buy it. Eli Lilly is a top 10 company now in terms of market cap, because it's trading at 50 times earnings. It came from 18. Healthcare companies trade at 13, 14 times earnings, and Lilly's at 50. So because of its potential addressable market, when you go back to NVIDIA and you go back to these large firms, they're not that expensive based on their margins and their potential growth rate. So you've got the banks at 9, and you've got NVIDIA at 24, and you've got Microsoft at 28, which arguably is a reasonable number for those firms. So I think that flows through into all the private markets in terms of venture capital, growth capital, and you're going to see those multiples persist.
But if you're talking about secondaries, as far as LPs having to sell their interest, that doesn't impact the underlying portfolio company. I mean, as long as the documents are drafted correctly, the LP needing to sell is the LP's problem. That doesn't really create systemic risk. If you don't want to make your capital call, okay, well, you forfeit your interest. You don't wanna, you wanna sell your interest? Well, I don't have to create a market for you. And so they might go out and they might have to take a big discount, but
That doesn't affect the firm that's already got the capital.
it doesn't affect the company that already has the capital or the fund that already has the capital.
All right, on that note,
Right, I think the principle is that if the value when you sell it, I mean, that's actually the only realistic valuation you actually have, is that I just sold an interest in a firm today at a 50% discount.
In the fund, but
Oh,
nobody,
and the fund's holdings.
and nobody has, and nobody has any interest, nobody has any knowledge into what those prices were. I mean, we do them all the time, it's very confidential, and so there's no market for that to aggregate that.
Well, I
value
think there's a whole bunch of hidden secondary transactions that are going on right now.
All day long.
Because there's so much secondaries in the market, there's humongous amounts of funds that were raised post 2009, because everything was great. Secondary did so well in 2009, 2010, that $20 billion funds were raised post 2009, whereas there was only 5 before that, right?
So I agree that it's not systemic risk, so I agree that it's not a systemic risk in terms of what we have in 0809 with the banks. But you're going to see the mark on the balance sheet on the wealth side. So the bigger the secondary markets get, the more the arbitrage has to flow through. And I agree it's not very transparent today, but by those people who are doing the deals, who are involved in the funds, because the secondary does get priced by many participants in the private market, they're gonna know what the prices are, so that number has to flow through, and they're all using a certain set of third-party evaluators that do the mark on all the funds. So those numbers, if you're the third-party evaluator, you can't ignore something you saw on the secondary side and then not price it on the private equity side in a particular fund. So I think it has to flow through to some degree, and I think you're gonna see that in the next few years.
I couldn't disagree more. You know, if Trump has to sell Mar-a-Lago tomorrow and everybody knows he has to sell Mar-a-Lago tomorrow, the price at which he sells Mar-a-Lago tomorrow is not relevant to its actual real price. That is not indicative of the price at which you could get in the open market.
But if it's systematically begins to happen,
Yeah,
so if not Trump, but Trump and his 10 neighbors have to sell it,
right,
that's the difference, right? So if 10 people are selling secondaries in the same fund,
yeah.
then that's the difference.
But not everybody knows.
then you hope the liquidity steps in.
Sure, it's private transaction.
It's really hard. You can't publicly advertise that secondary. The maker of the fund can't create a market.
That information goes out, because
Right.
and the other side of the coin on secondaries is that there are so many secondaries agents today that they open up the kimono on secret transactions like nothing, right? Again, I had a guy call me up, a year and a half ago, he says, oh, I got all these secondaries, blah, blah. I said, what kind of space you say? Oh, everything's going to 30%, 40%. So I said, what about this FTX company? So all the crypto companies were selling at, 10% of their valuations. And he's like, wait a minute, and he came back to me 5 minutes later and said, oh yeah, you can get FTX a $10 million slug, 50% off. And I was like, how can FTX be buying all these companies going out of business if they're themselves are selling at a discount?
Right.
That doesn't make any sense. So at least if you have the knowledge of it and you talk to all of your other investor friends, they know.
They don't know. They don't know.
But the
The vast
Sure, they
majority.
do as soon as I talk.
No, the vast majority of secondaries that happen, there's no broker involved. It's the manager and the manager's buddies buying somebody out. That's 90% of that market. And I see it every day.
All right, and on that note, we're kind of hitting the deadline. Go ahead, Mark. Rick, sorry.
I run an investment group and our last 35 family offices were there. And I commented that this was the most bullish I've seen in 15 years. I'm older than 15 years old, my brother was invested for 15 years. And I'm hearing the same thing from you guys. What I'm really hearing from you guys is there's so much capital. And I think that's the capital that was created with COVID on the sidelines that we really can't have to take down. Am I right or wrong?
I saying that due to the capital on the sidelines, and we have to draw down.
I think you can go sideways in a very exciting manner. Meaning that there's enough money available looking for those opportunities, and the money's coming into those funds where they have to deploy certain funds.
There may be a ton of money, but you have to have the underlying fundamental economics. Like, I don't get Miami, for example, the real estate prices are going off the charts, but the average income is $45,000 a year.
I agree. So the way that you really lose wealth is over a longer period of time of just not going anywhere. It's not like a 1987 October environment where it all happens overnight. It's the repricing has to happen over a certain period of time. It's still not happening in real estate, right? Real estate has to reprice given the risk premium, given the rates are 5%, and bonds are still, even bonds are mispriced relative to cash. That is still, you don't even see that still in real estate.
Right.
That's
it's not
easy.
just-
Real estate is easy, like the
There's a-
simple.
There's a whole other issue with real estate, and I will say that in 1962, you bought a condo in Miami Beach for $70,000. And 20 years later, it was still $70,000. In 1983, that condo did not appreciate at all, right? So I mean, if you're from Miami, you know that, right? That's what happens when you buy, because the tops it, right? So that's one thing, but the second thing is this, a lot of people bought real estate as investment portfolios for like Airbnb, et cetera. They outlawed Airbnb in New York, and they just outlawed it in Virginia.
If you look at the public markets, and you look at the dispersion across public markets, you're already seeing what I think we're going to see in private markets, where there's a huge spread across valuation and across earnings and across margins depending on the sector. You can find, there's a tremendous number of firms that we all know, all the names that have been around for 20, 30 years, they're trading 8 and 9 times earnings, and there's literally trading at 49 and NVIDIA at 24. NVIDIA was at 60 before it had the huge couple of quarters. It was 60 times earnings, and then it said, well, earnings went up 100% this quarter. So people who bought it knew what was going on, most of the market didn't know. So that dispersion, so to your question, Rick, about what we're kind of going through, I think you're gonna see, I think Marty used the term yesterday, rolling recessions. They're not rolling recessions, but they're rolling valuation mountains where you go up and you go back down. And there's enough sectors, enough money, I think that means you end up going sideways in a lot of different areas.
All right, and on that note, we've hit our time, but if anybody would like to follow up with any of the panelists, by all means, reach out to Marty, whether it's portfolio construction with the room, or Paul on the legal side, or Evelyn with family office consulting.